Hi, it's John Kelly. In this module, we are going to discuss the revised standard section 600 on group audits. And as always, we want to be efficient and effective, follow professional standards, and document what we have done properly. Now, the particular problem in group audits is there are some countries that effectively mandate non-cooperation of a subsidiary auditor. So there are some countries and auditors around the world who just won't talk to the parent company auditor, deny them access to the audit file, deny practice inspectors access to the audit file, and it's a problem. So it's a major issue. So the standard, one of the main reasons for this change is to get the standard to address this more clearly. Now, I'm mostly going to focus on the impact of this standard on a small firm. Network firms and big firms can figure it out for themselves. I'm sure they already have. But from the perspective of a small firm, anytime there is a consolidation, it's a group audit. If you use the equity method, any kind of subsidiary investment, putting together two divisions, anything like that, it's a group audit, and the group audit section applies. And it remains a group audit, and the group audit section applies even if the small firm audits both the parent and the sub, or also audits the division. It's a group audit, the section applies. But before you panic, it applies in a reduced form. And when you see what the reduced form is, you will say, well, actually, that's just kind of a common sense way to do the audit of a parent company that has a consolidation. That just kind of makes sense to me. So I think you'll see what you have to do isn't that onerous and probably a good idea anyway. Now, other firms, if you're a network firm and say, well, is it a group audit if we're a network firm? Yes, it is. If we're not a network firm, yes, it is. If you're one of the big four or the big eight firms, perhaps it's a group audit and the standard applies. I'll let the big firms figure that one out. I don't know. Maybe it is, maybe it isn't. But I think the point is you want good communication with whoever is doing the subsidiary audit. If you're auditing the parent company, you're the person that's going to get into trouble if there's a material misstatement because the subsidiary audit was done wrong. And the subsidiary auditor is probably going to be immune. They might even be in another country. So it is really important that you have good communication with and make sure the subsidiary audit is done well. And that's what this standard requires and suggests. Now, CPA Canada says that the new standard has accomplished a bunch of things, and we're going to go through this. It says it clarifies how the standard applies. And it is somewhat clearer, or perhaps there are just a whole lot more words. And I wonder whether if we applied the clarity standard and trimmed away some of those words, it wouldn't just go back to the way it was before. And I don't know that having a whole bunch more words makes something clearer. But anyway, that's what they've done. It says it clarifies how the standard applies to investments carried at cost. And I think I have to disagree. The words at cost do not appear in the section. It's perhaps implicit, but if it's implicit in the new section, it was implicit in the old section was there before. It says it takes a principles-based approach, fancy words. What that really means, I think, is that it's easier to scale down than it was before. And it even says if it's needed to and it's right that you should scale down what you need to do, you can scale it down. It says it emphasizes the special considerations for a group plan. The words in the old section and the new section are virtually identical. It says it requires the group auditor to determine the nature, extent, and timing of the involvement of the component auditor. Again, the words are virtually identical, so okay. Highlights that the component auditor can be involved in all phases. Well, of course they can. clarifies how materiality and aggregation risk apply. Now they've introduced a new term, aggregation risk. It's a new term. And what it really means is that you cannot set component materiality higher than group materiality, which I think would have been obvious before. If you have a parent and you have a subsidiary and you have the combined or consolidated financial statements, presumably the consolidated statements have a higher materiality than either the parent or the sub. I would have thought that was obvious. Apparently, I assume it wasn't, so they've made that clear. Fosters a skeptical mindset. I disagree. That's not true. All they've really done is add a reference to Section 200 about professional skepticism, which applied before and still applies. Refer to it or not, it applies. It's an annoying habit standard setters now have. They continually reference, in applying Section 350, you do the things that 350 says you have to do. Well, of course you have to. It's kind of annoying, and it just makes everything longer. It says it reinforces communication. Again, the requirements are basically identical. They certainly have reorganized. Every item in the old section has been moved to a new paragraph or paragraphs in the new section, so I don't know how much that's reinforced. But as I said, communication with your component auditor is extraordinarily important, and making sure that the component auditor does what they're supposed to do and tells you what you need to be told, really important. So I guess I can't terribly disagree, but it's basically identical. Talks more about the restrictions on the component auditor to communicate. That's correct. There are lots more words, but the meaning is very similar. More documentation requirements and discussion what to do if you can't overcome restrictions. More words, but the concept was there before, and if you can't get sufficient appropriate audit evidence, you resign. Now, what the section says is you consider your alternatives, but basically if you can't do it, you're probably, well, maybe you won't resign this year, but you might resign next year. If there's a major subsidiary and you just can't get sufficient appropriate audit evidence about that subsidiary, you can't continue as auditor. Anyway. And then they're quite proud that they've added references to every other imaginable section. It's true, and it's annoying. Now, I find that standard setters in Canada and around the world tend to exaggerate the changes. And I wish they wouldn't do it, because I find it misleads me into thinking that something has actually changed when it hasn't. Perhaps what's going on here is they have noticed that folks are ignoring the section, and they exaggerate the changes to get the attention of the people that have not been following the standard and get them to follow the standard. Now, again, to focus back on what the small firm needs to do, there are basically three things you need, three checklist documents that you need to have and prepare if it's a group audit. So the first thing is a checklist of things to do. There are 27 items in the standard of things you are supposed to do if it's a group audit. Only 4 apply if you audit both the parent and the sub. And they apply to each component auditor if the subsidiary audit is done by a different firm. So if you have 3 components, 3 component auditors, you will need 3 versions of this checklist to make sure you've done everything you need to do with each of the component auditors. Now, the 4 things that will be relevant if you do both parent and sub is don't set parent or sub materiality higher than consolidated materiality. I think that's obvious, but not a bad idea to be reminded, and not a bad idea to document that you've done that. Document your audit of the consolidation process. Now, in my practice, most consolidations were pretty simple. You just added the 2 together, basically, and perhaps there was an adjustment or 2 eliminating intercompany sales or something like that, but it was never much. So they suggest that you make sure that all subsidiaries are included. That's not a bad idea. Take a look at any consolidating journal entries to make sure they're done correctly. Look for bias or fraud. Now again, most consolidations that I've seen were so simple that it would be hard for there to be either bias or fraud, but not a bad idea to document. Make sure all the subsidiaries follow the same gap. If you have a parent in Toronto and a subsidiary in Los Angeles, the parent in Toronto will be following Canadian GAAP, presumably IFRS, and the subsidiary in Los Angeles will be following US GAAP. So you're going to have to find a way to make sure that the sub has switched over from US to IFRS. Maybe they're the same, or maybe there aren't significant differences. And make sure that all the year ends are the same or somehow or other adjusted. 4 things you probably want to do anyway, 4 things you probably did anyway, but perhaps 4 things that you didn't document, perhaps as clearly as you might, so maybe this is not a bad thing, just to remind yourself to document those 4 things. Second thing a small firm needs is a documentation checklist. There are 8 items in the standards. Pretty simple. The responses are pretty standard. One of the things you are to document is how you determined the basis for materiality. Now, for me, I would say I determined a materiality based on my professional judgment and my understanding of the users. Now, I know there are other people who are more enthusiastic and who would say, oh, no, you need to write a big long memo where you took 6% of this and 5% of that and took the square root of this and added these 2 things together and on and on and on and on. Very enthusiastic, and they're responding to a practice inspector who might say to you, do you not agree with me that you could have said more about how you determined materiality? And I would look back at the practice inspector and say, no, I think I've done enough, I'm fine. I think if you look at the standard on materiality, it would say that that's exactly what I'm supposed to do, and I don't need to document much more than that. Now, the other problem with a long memo is it takes a long time to write the first time, and you'd have to go through it very carefully to make sure, the math was right and that you didn't say anything contradictory, and it would just be, you'd have to spend a long time on that memo. But then you also know exactly what's going to happen is it's just going to get carried forward year to year to year. And by the time that's happened for 4 or 5 years, you're also pretty sure that something's changed and something in the memo hasn't been updated, and our determination of materiality is no longer appropriately supported by our 10-page memo. So that's one of the reasons that I go back to, I determine materiality based on my professional judgment, just like the standard said I was supposed to. Third thing you need is a letter to and a reply from each component auditor. Said that before, 3 components with 3 different auditors, 3 letters, 3 responses. What's in the letter is straight from the standard. It's pretty much unchanged from before, but you need to go through the new standard, make sure that you are communicating each of the things the standard requires. So is it really new or not? Well, it's not really new. But if you're a small firm, I think what this does, it gives you a super opportunity to make sure that your procedures are up to date. So if something in this has surprised you and you said, oh, I never knew that was a group audit, well, perfect, because CPA Canada has told me this is completely different. So what I was doing before was okay, because it wasn't required by the old standard, even though maybe it was. But we've now updated our procedures, and we're now okay on the new procedures. And what we did before was okay because the old standard didn't require it. But we've now fixed it. Now, I have invented checklists and a draft letter from this, as I do. And if you want a copy, use the email below, the Gmail account below, and I will send you a copy in Word of my version. Now, no liability. That is, you need to be satisfied that with your own reference to the section, the checklist meets your needs and satisfies the requirements of the section. So there is no liability in excess of what you paid for the form, which is free. But like I say, if you send me an email at that address below, within a day or 2 or 3, I will email you my 2 checklists and 1 draft letter to a component auditor. So, thanks for listening.